Right. Hi, Chris. So 152. So again, like I said, your work getting better, very clear. This question asks about audit risks. I think I gave you 3 out of 4 here. Because you start off with a strong definition. We'll go to the answer with what audit risk is. Inherent risk. I think inherent risk, the risk that preconceptions of data are incorrect and can lead to. Yeah, I think I understand what you're trying to say, and strangely enough, I don't think I think I get what you're trying to say. But really, we're really saying that anything else apart from controls could be causing this. So we're really saying, in simpler terms, really, that the nature of the industry, or just any other related reasons, just to the nature of the business or the industry, or the things that are almost external to the business as well. So kind of that world of pestle, the volatility of the markets in which this business operates, the nature of its financing, the nature of the products, if you like, the fickleness of the industry, the fact they might lose customers now, just anything that's nothing to do with controls. So what I'm going to do is I'm going to go through these and then go to the answer so you see exactly where we're going, and then give you some kind of, think of it like peaking, the things you do to peak at this type of question. So you have control risk, yes, things that are not picked up by internal controls, and that's true. That's good. I just thought picked up was just not a technical term. So you could sort of just, if you like, we're just not. I think a different adjective, I guess, would work there, where we're not mapped out, or we're not covered, or we're not discovered, if you like, or bypassed internal control, or internal control wasn't able to. Yeah, but I might be wrong. I just didn't. I just thought it wasn't very technical, but I think you'd still be all right. Detection risk. This was good. You're very aware of what's going on here. So let's look at the answers for this thing here. Again, I think I highlight the fact that you saying that audit risk is made up of 2 risks. Well, the key point here is you might be expressing an inappropriate audit opinion, where audit risk is a function of 2 main components: the risk of material misstatement, if you like, the fact that there might be error here due to this initial inherent risk and control risk, and detection risk. So this is in itself takes your work up a bit, and then you break it up, talking about the risk of material misstatement is made up of 2 further components: inherent and control. So when I was saying earlier on that getting to 50 is not such a 49, but when you start talking like this, you're over the line. You're over the line. You're showing the examiner I know exactly what I'm talking about. Now, this is what, if you can remember this, the key point here is we're talking about assertions here, right? And all we're talking about is the income statement, class of transaction, the balance sheet or statement of financial position, account balance, or disclosures. So remember, the key point is there's 3 areas we're really arguing here where we could have a risk of. You're asserting that those figures are complete, they exist, they're the right value. So the argument here is that inherent risk is really saying that is a susceptibility, or we're saying that this assertion, there's an assertion about either of these things in these areas, that these things could be material due to there might be errors here, basically, before consideration of any related controls. So I'm saying that there might be errors, anything that could cause an error in these areas, but nothing before we start talking about controls. And control risk, sort of saying exactly the same thing, but pretty much the fact that internal controls could not prevent it or detect it, if you like, prevent or detect. So again, it's just language. It's just language. And detection risk is the fact that procedures performed exactly what you've said. We perform our procedures and we've not been able to pick it up due to this is very much a sampling or a non-sampling risk. Right. So let's go back to the next question. The next question is, then they then ask us to identify 8 audit risks. So again, like I say, now you'll just be getting better with this because you're starting to focus on the actual figures. Again, don't worry so much if you're thinking maybe don't understand the FR, but you'll pick it up. And it's still, I wouldn't even call it FR. I think the accounting concepts are still enough to get this. So these people distribute products through its website. They've upgraded the website at a cost of this. Additionally, to purchase a new warehouse, and these guys are still working on this, and then they issued these shares. So you can see the number of issues here. Disclosures are always big. Has all this been disclosed as they should be? So let's start off with the fact that we're upgrading a website at a cost of this. So again, a website is an intangible asset. How much of this is, if you like, how much of this is capitalization and how much of this is just maintenance, if you like? And so we need to be clear about whether or not, because the argument here is that if we don't do this correctly, intangible assets will be overstated, if you like, and therefore we're really overstating our assets. Or if you like, expenses are understated and therefore overstating our profits. Then it says you've bought this new warehouse. The question is, it's really about the fixed asset register. Is it on there? Has it been recorded? Is it in the fixed asset register? That's the key issue here. That's that. And it says, it's slightly unclear, you've entered a transaction to purchase a new warehouse. So I just need to understand whether or not you have bought the asset. Where are we? So again, like your answer you mentioned earlier on, discuss with management where we are. And it says here, legal advisors are working to ensure the legal process will be completed by the year end. And then, so we're really trying to investigate what's going on here and how this will be purchased. So basically, if you haven't purchased it by the year end, it should not be on the register, is the argument, right? Because someone could say this and then go and put debit asset, because it just makes them look better, doesn't it? You've issued £5 million worth of. So the question here is, how has this been, if you like? Oh, you've issued this to record the finance, the warehouse purchase. So. Irredeemable. I don't know if you remember, you might remember this from your earlier years, but the key point is that we have irredeemable preference shares here. So these are technically equity because you don't have to pay them back, right? So you've got the money in the bank. So the question is just really about where have I classified these? These are technically kind of equity. So it's a classification issue, really. Now, anytime you see this, he's increased the useful life to 3, and he felt this would be more appropriate. We have to ask the question, what is your thinking behind this? Let me break this down. If someone says that we typically use assets for only 3 to 4 years, then this is fine, because you're literally saying we buy an asset, we only use it for 3 to 4 years, and then we dispose of it. That's okay. So we need evidence. We need to be looking for other assets that the same thing has been applied to. If not, we probably think you're doing this to reduce your depreciation figure, aren't you? Because by extending the useful life, depreciation costs will fall. So, carrying on with this, it says here that an engagement partner has been, the finance director has informed that a revised credit period has been agreed, as they've been experiencing with one of your, owing to yourself. So we know there's a trade receivable issue here, isn't there? So we need to know whether or not we need to create a provision, whether we need to, currently trade receivables are overstated. So we need to explore circularization, speak directly with the lawyers. So you can see that it's, again, I highlight the fact this is to do with my statement of financial position. That test of balance. Is that the fair figure? Anytime anyone introduces a new bonus based on sales targets, we know that there's straight away we will have an overstatement of revenue, because people will start overtrading, pushing sales, and then we want to be, and there's the cutoff issue. Question is, they're basically trying to improve their sales figure by just selling, and they might end up overtrading. So we know there's a likelihood of bad debt, sales returns. You can see it says here, new customers have been given favorable credit terms. So we're now worried about potential trade receivable bias. So we might need to increase that provision or reduce that. And end up making sure the trade receivables are not overstated. It's launched several products. A couple have been successful, so we need to be looking at if these have not been, but one of these hasn't been successful, so we need to be thinking about writing down, right? Because it's overstated. So writing it off as all the money invested, writing it off as an expense. And now they have some legal action, so we need to be speaking to the lawyers about potential provisions. So I'll kind of So we can see that there's there's a bit more here. You can't, so I think the question wants you to talk about safeguards. So let's go to your answer and see where you are on this. I think I was happy with your earlier work on A. And I think what you did, maybe I think in your hurry, you mixed up some of your safeguarding issues with your audit risks. So safeguards are very different. The threats and safeguards are your really threats to your ethics as an auditor. Audit risks, again, I highlight this. We're focusing on things in where the financial statement figures might be inaccurate or, if you like, in simple terms, overstated or understated. So when you think audit risks, think overstated, understated. Risks are threatening our objectivity, self-review, blah, blah, blah. So you write here, these could be overstated. You don't quite explain, but I write expand. Last year's audit has not been paid. This is not an audit risk. This is a audit. This is a threat, if you like. So this isn't quite an answer here. This is yes. This is good. Yes. Where you talk about useful economic life. This, of course, is a threat, not an audit risk. And here we are. This is also a threat to our self-interest. So let's go to the answers and sort of see the sorts of things they're talking about. So you can see here they're grading their website. We're allocating between revenue and capital expenditure, as we talked about. We don't want this. They've used misstated. I would probably argue it's safe to say there's a risk that this is intangible assets are overstated and expenses therefore understated, because that's typically the way people will behave. Now the response is, again, it's a very standard one. We want to review a breakdown of the costs and literally look at what's making up those costs and really have a breakdown to see what should. So you can see the response there again, looking at that breakdown. I didn't even pick this up. The key point is that we might have a loss of data. So anytime you see anything about systems, you're thinking errors, loss of data, incomplete transfers. So I actually want to carry out tests on the completeness and transfer of that data and accuracy. Think of it like opening balances. If you get the opening balances transferred wrong, everything else is wrong. So I want to test the opening journals almost, if you like. New house, legal process, exactly. Again, like I say, only assets which physically exist should be included in the property PPE. So is it there? And inspect legal documentation of that ownership, if you like. Significant finance has been obtained, and we'll come to where we talk about finance a lot. When we see finance, we're thinking classification between current and non-current. You might have seen me play about with that a lot. You're thinking interest as well. Significant finance has been obtained, 5 million. Again, we need to finance this finance needs to be accounted for correctly with adequate disclosures. So very much big on disclosures. But again, as you write and write and write, you start to remember. The preference shares are irredeemable, so they should be classified as equity, right? Because they're irredeemable. You're not getting, the money isn't coming back, so it's all equity. Failing to do that might lead to an understated equity and overstated NCA and non-current liabilities. So we're reviewing the documentation and looking at that again. Useful lives, I talked about that, and discuss what's going on, and then compare this to how often these assets are replaced to see whether that's a fair way of thinking about it. Again, this is the bit where there's the outstanding balance of 1.2 million. So we want to look at that and really see what's going on here, because trade receivables might not be recoverable and hence overvalued. So we really want to look at the actual contracts and see what's going on with that particular customer. So anything you write along the lines of because you're just looking to see whether or not after the year end they're actually getting any of this money, and then decide whether or not you're going to have to put in a provision or just write off some of that debt. Again, this is this issue of a sales related bonus like I talked about. So these are, I mean, again, this is the first time you're doing this. So these are big risks. So the risk here, again, is that potential trade receivable overstatement, really. Potential trade sales revenue overstatement, because we might have a lot of sales returns. And so again, here, this is a risk of sales cutoff, as customers could place orders within the 2-month introductory period and subsequently return these goods post year end. So again, if you remember me highlighting the fact is that all sales returns post year end that relate to our year must be reversed. We must reverse that journal as though they happened in our year. Right. So, and then again, as you do this, you'll just start seeing what's going on. Again, this is this product that they've stopped selling. So we need to write down, if you like, and just basically the product's no longer whether you've recorded it because it was in development, so you record it as an asset, or if it's even in inventory, it doesn't really matter. It's lower cost NRV, if you like, when we compare. Um, Again, this issue, same here with the product. And then fine, I think your last two, this question of legal action, we need to speak to the lawyers. I didn't even pick this up, but the key point is anytime anyone tells you they want you to come in and do an audit really quickly, you can give them options. You can tell them we can come in and do some interim work if you like to reduce the pressure, and again restate those agreements that you had earlier on. But you always want to kind of give some, if this is, or think, tell them this will charge you more if we have to bring more people in. But the key point is we're very aware there's going to be pressure. But the risk, of course, is detection. Of course, there's a detection risk that we'll miss things, if you like. Again, risk of errors, and if you like, professional skepticism is what we're thinking. Again, there's a couple more, but again, I didn't even pick up on that one. Then, of course, the ethical threats, you seem quite happy with those. Again, there's some ethical threats here. Keen to report earlier than usual. Non-executive has asked us to assist them in recruiting. Well, advocacy, really, this is a self-interest threat. This is an advocacy threat, I would go with. And we can't really help them. I mean, here it says, I mean, anything you write here, you could just say, no, we can't help them to maintain our independence. But it says here you can help them review a shortlist, but you can't actually, you can't be seen to be making decisions. I would probably just say no. I don't think there's a right or wrong answer per se. Again, it says the engagement quality control reviewer was until last year the audit engagement partner. There's not enough independence there, right? Remember that this is the quality control. This is the second partner, so you almost want him off the job for 2 years, so someone else can come in and kind of we want better independence. So you can't have the engagement partner turn quality control reviewer. There's not enough independence there. So you for 2 years don't get involved. Again, here, it says here that you provide taxation services. So this is this 15%. There's no problem with taxation services in terms of self-review because they're very different departments. But the question is, the 15% of gross over 2 years is an issue, right? And again, now that I'm saying it, you'll remember it. And that's really the issue. So there's a self-interest intimidation threat here because if you become over-reliant on that, then you really start to not do the right thing. This is a good one. 20% of is outstanding, and you mentioned that. So we really need to discuss when are we going to get the money and put something together. So you can see that a lot of the textbooks will say don't do any more work until you get the money. But you can see here they've asked you to actually put some kind of fee structure, revenue structure in place to try and get your money. So a range of answers there. Please review those. And but let's go back to your work. So yes, I think that initially your work it's getting better. And I highlight here there are a lot of financial risks that you could have gone with. An audit is not FR, but FR is still central. So you're really looking for those finance figures to play with, and you have to have a stab at them, and then you get better at finding out what the audit response is. But don't worry so much. No, once you see finance, you're thinking there must be an issue here, and so apply the standard concepts of accruals, if you like, prudence, if you like. I think prudence and accruals and going concern are your big ones, and realization. So these are all concepts that come back to play a role in audit. Okay, great stuff. See you in the next question.